So, you know that massive AI boom that everyone's talking about? What if I told you it might be setting the stage for its own epic reversal? Today, we're going to dig into this really fascinating theory about how money moves around the globe in the age of AI. And, yeah, how a huge surge in the US could actually create an incredible and totally unexpected opportunity on the other side of the world. Okay, so this explosive growth, it feels kind of familiar, doesn't it? Like we've seen this movie before. It's got all the classic signs of a big tech boom and, well, a big tech bust. So the question on every investor's mind is this time really different? Or are we just watching a massive bubble inflate right before our very eyes? To really put this into perspective, let's just throw a number out there. $5 trillion. That's the mind-blowing valuation a single company like Nvidia is getting close to. I mean, that is larger than the entire GDP of India. This isn't just normal growth, folks. This is a crazy amount of money getting funneled into one tiny, super specific corner of the global economy. All right, so first up, an overheated hype cycle. We're going to examine the warning signs of a bubble. So what's really driving all this? Let's dive right in and look at the red flags suggesting this whole thing might just be an overheated hype cycle. So where is all this cash coming from? Well, the fuel for this fire, it's coming from a really, really small and concentrated group of the world's biggest tech companies. We're talking about the Magnificent Seven. You know them, giants like Google, Microsoft, and Amazon. They are just pouring billions upon billions into AI. And this concentration of investment, it's a huge piece of the puzzle here. And here's where it gets really telling. It's not just outsiders saying this. Even the leaders at the very heart of the boom are starting to sound the alarm. I mean, when the CEO of Google, Sundar Pichai, comes out and says something like this, you better believe the market listens. That single comment caused a huge stock drop for Nvidia, and it just shows you how fragile these valuations really are. And look, this follows a classic playbook, right? First, the hype goes through the roof. Then, the insiders start voicing their concerns. And what happens next? The smart money starts quietly slipping out the back door. We're already seeing it happen. Major players like SoftBank and Peter Thiel are selling off huge chunks of their holdings. It's a pretty clear signal that the bust part of this cycle might be a lot closer than we think. Okay, Section 2, America's concentrated risk. Let's look at why the US market is so uniquely vulnerable. Because all this hype isn't just about a few tech stocks anymore. This is building into a serious structural risk for the entire US market. We're talking about the very foundation of the American economy. And this chart right here shows you the core of the problem. A massive chunk of the US market's value is all tied up in just those few Magnificent Seven tech companies. The stability of the entire S&P 500 is basically resting on their shoulders. So if their AI-fueled growth starts to sputter, the shockwave could shake the whole market. So the crucial point here is that these current valuations seem to be built way more on hype, on extrapolated hype, than on realistic returns. The market is pricing in a future of infinite rapid growth based on the promise of AI, not necessarily on the tangible profits it can deliver right now. And that gap between the hype and reality, well, that's the very definition of a bubble. All right, now for something completely different. Section 3 is all about India's built-in shield and how a different market structure offers protection. Because while the US is doubling down on AI, a totally different economic picture is emerging on the other side of the world. India's market is built on a foundation that looks very, very different. And the contrast is just stark. It's night and day. India's Nifty index is dominated by sectors like financial services, infrastructure, consumer goods, and automobiles. These are industries that are way less exposed to the volatility of a global tech bust. It's like they have this kind of natural insulation built right in. This creates what the source material calls the non-innovator advantage. Now, I know that sounds totally counterintuitive, right? But being a nation of software service providers instead of product innovators actually acts like a shield. See, these companies have more stable, contract-based revenue. They aren't so dependent on hitting the next big AI home run. And like we said, we've kind of seen this movie before. Just think back to the 2008 financial crisis. India's economy was relatively shielded because it wasn't all tangled up in those complex global banking products that just imploded. So the theory here is that, in the exact same way, India's low inclusion in the AI hype cycle could protect it from a potential bust this time around. So if the US bubble pops, what happens next?
This is where the whole story turns from being about risk into being about a massive opportunity. Let's dive into Section 4, the coming capital flood and the opportunity for a bullish future in India. A crisis in one market, you see, could create a huge opening in another.
The theory predicts that a downturn in the US AI sector could directly translate into a major upswing, a bull movement for the Indian market's Nifty index. It's literally the other side of the coin from the American risk. Here's the logic behind it. Capital is kind of like water. It always seeks a safe and profitable place to rest. Right now, foreign portfolio investors have pulled a lot of money from markets like India to go chase the AI rally in the US. But if that bubble bursts, they're going to be looking for a stable, non-AI exposed safe haven. And India, with its diverse market, becomes a prime candidate for all that capital to come flooding back into. And that becomes the single most important question for global investors in a world after an AI bubble. If trillions of dollars suddenly need a new home, you can bet the markets that are structurally insulated from that initial crash are the ones that stand to benefit the most. But hold on, there's one more layer to the story that goes way beyond just stock markets. This is Section 5, data, the real commodity. And this gets right to the heart of what the AI revolution is really all about. Because think about it, the biggest resource for training AI isn't just chips, it's data. And with its massive, digitally connected population, India is effectively one of the world's largest laboratories for collecting the human data that fuels these global AI models. This is exactly why so many of these platforms, from GeoGemini to ChatGPT, offer these incredible tools for free. They aren't selling you a product, you are the product. They are collecting the real commodity here, our behaviors, our interactions, our emotions. And all of that will be monetized later through some incredibly sophisticated sales and advertising. So this leaves us with a final, crucial question to chew on. While all the markets are obsessing over chip valuations and software hype, what if the ultimate long-term value isn't in the AI tools themselves, but in the human data that actually gives those tools their power in the first place? Something to think about.